So see, yesterday we had a discussion around collateral management. So it means it was related with the assets. So assets you can place to raise capital, uh, you know, or else if you have assets, maybe you can, sorry, if you have, let's say, if you want to own assets, you can pay a small portion of amount and you can own the assets for a time being, and even you can, once you are in profit, you can sell it out to the other participants and book the profit. So that's what we have understood in our previous session. So it was all about collateral management, right? And even margin call also that we have discussed. Okay, now in this session, see, there is no big difference between collateral management and security borrowing lending first. Okay, second thing, if you want to, let's say, lend these securities, lend it means udhar dena. So if you want to lend these securities to the borrower, so the first condition would be you should have the securities in your demat account, then only you can lend the securities to the borrower. Did you get this, what I said? So if you want to, let's say, lend the securities to the borrower, right? So let me just first define the security borrowing and lending. Security borrowing and lending, it means the original owner of securities can lend the securities to the borrower for fees or commission. Why security lender lend the securities? I have answered this. Okay, and the borrower borrow these securities on credit to short sell or mitigate settlement obligation and pay the interest or fees to the lender of securities, and on maturity borrower will be responsible to return the securities back to the lender, right? In case of any default risk or any unforeseen circumstances occur, what's the wording? Occur, then borrower will be penalized, okay, and What's the spelling here? Penalized and even can be book the case in court or with SEBI. See, this is how your this securities, the borrowing and lending things come into picture. Okay, but we'll discuss the flow, what exactly happened, so that you can understand it. So, can you hear me, guys? Someone is calling, so I'm sure you won't be this one, but still I'm asking. Okay. So, am I audible? Yes, no. Can you hear me? Okay. So, note down this one. So, now if I, let's say, try to, you know, chart out the flow, how exactly happened. So, let's see here. Sorry, my bad. Okay. Note down this flow, please. Uh, you can also try to note down in your notebook as well, because this flow will help you to practice for an interview, and definitely you would see lots of questions around this. Okay. Now if I talk about, let's say, SBL process. Oops. Borrower and lender. Okay. So always you would see like lender and borrower which come into picture. Okay. So what happened? Let's say lender, it means original owner. Lender, it means original owner of securities who is holding securities in demat account. That person, you can call it as a lender. Let's say lender is holding Wipro shares of 1,000 quantities. All right. And the borrower is looking for the sell of same quantities, right? So current market price, let's say it looks like uh, current market price which is at 300. So here an assumption would be borrower borrower feels like this 300 which is at a very high. So for example, let's say how research works out. So trade view, let me go in. Yeah. So if you look at this chart, let's say you did some research and you got to know. So the daily chart which doesn't look good. If I put it monthly, so still you might see, let's say, because the stock, it was reached to the 175 rupees per share after the, I think, bonus issue, because it was trading at 700. From 700 to came down at 175, and again from 175 to it was reached to the 320 here. But the quarterly result was disappointing, and uh, that's when the stock price, which was started uh, going down. Okay, let's say you're at a borrower side, you don't have any your shares in your account. All right. So what you studied, let's say at this point in time, when the stock price it was, let's say, maybe 300. So you felt if you try to sell the stocks at this level, because see, the original lender is still holding the shares, maybe let's say since very long, not in a position to sell the securities, maybe let's say in next 1 year or next two, or maybe even let's say not interested to sell the securities in at least month, right? Again, it's an assumption. Selling of securities in the market, it's your personal decision when you want to sell, when you want to hold, when you want to take any sort of action. It's your decision. But we are assuming two different situations here. The original owner of securities don't want to sell the shares, just want to hold the shares in the demat account, and the borrower of the securities, let's say, who did who did some sort of research and found, let's say, to the borrower, like, if the borrower sell the security at this level, okay, 300 level, so might be borrower can make money and sell the stocks, let's say price which is at 250, and make a profit almost 100 rupees per share. Okay, now, so next step would be the borrower reach out to the, not directly to the, see, in a stock market there are two ways. The big investors directly reach out to the each other, but the small investors, they can't reach out to the each other. Okay, because they will be rely on other participants like broker, bank, or custodian, because there would be lots of other financial institutions which come into the picture, and they will be rely on that only. So now, lender is holding securities in demat account. Borrower want the securities at this point in, at this point here. so that borrower can sell the securities. So borrower can simply reach out to the broker and ask broker to intermediate or try to, you know, make it available, let's say 1,000 quantities at, let's say, if the market price which is at 300, fine. So this guy means the borrower is looking for this quantity. Okay, what does it will ask for a joining and blah 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 blah. So it's a big fraud. So every time to join this, join that, and again do the rework. All right, and here is your lender. And so we are assuming that lender is also holding 1,000 quantities, okay, in the portfolio. So a broker, let's say borrower reach out to the broker, and if the broker, let's say, reach out to the lender and ask lender to provide securities on credit to the borrower, then maybe borrower or sorry, lender or broker can, you know, discuss the upfront fees or interest rates, or maybe let's say commission. What would be my commission if I borrow my securities to the borrower, maybe for a 10 days, 20 days, 100 days, or whatever period. See, period is based on the circumstances, right? So they'll say it. So now let's say trades initiated at this level, let's say ICICI direct intermediate for lender and borrower, trade initiated, the terms was like 1,000 quantities the lender lent to the borrower, and the borrower deposited around 3 lakhs with whom, with broker as a, you know, the deposit amount as a guarantee, you can say. And let's say broker reach out to the lender and released the securities from the demat account on behalf of, let's say, lender, and transfer that securities to the borrower. See, in this case, if you see, one thing which is very important, that is the market price of securities. See, this particular contract executed at 300 price. If security price goes down, right? If security price goes down, not to worry, means both the parties, because original buyer maybe would be in little bit pressure that, you know, if the stock price goes down. But anyways, the intention of the original buyer is to hold the securities in demat account or to hold the securities in the account, correct? But for borrower, if price goes down, then borrower would be in profit. Why? Because borrower borrowed the securities and, let's say, sold at 300 directly in the market, correct? See, if the price goes up, then borrower will have to whatever amount, let's say, it was initially paid, let's say initial amount it was paid like, let's say 3 lakhs. What if this price, let's say, from it goes like 300 to 320, contract price is this, and we are saying the current market price during the period, let's say it was 320. See, in that case, how things happened? In that case, borrower will have to pay 20 into uh, 1000 would be around almost 20,000. So 20,000 additional cash will have to pay to the you know means borrower will pay to the lender or to the broker, in short, I would say. Why? Because see, the logic is very simple. You have borrowed securities at a price of 300, and if that security price, let's say, goes up, so it means you will have to make sure you have deposited the money in the, let's say, your margin account to maintain the mark to market. Now your question would be, sir, what is mark to market? Mark to market is nothing but mark, it means, sorry, mark, it means contract price or purchase price, and market. So market is all about, which is current market price. Current market price. All right. So we always compare mark with market. So we always compare mark with market, and it's very important. Okay. So to why we compare it? Because we compare the security mark or contract price with the market to understand the unrealized and realized gain of securities. Basically, current market price, which help to understand or to know the fair value of securities, and which is something very important, because without knowing fair value of securities we won't be able to capture or calculate the unrealized gain and profit from the contracts. Did you get this? And definitely you would see questions around what is mark to market. Mark to market is nothing but it's a terminology or a term which can help to understand the difference between contract price and market price. So if, let's say, your contract price is 20 and market price is 30, so for a buyer the contract would be in profit by 10 rupees. So that's how you can understand the terminology of mark to market. So don't get confused. See, if you read it like mark to market, this might confuse you, but this is very simple. Mark to market is something. So let's say your contract price signed was 10 and the current market price is 20, so you can calculate your gain. And if there is no difference, then which is fine, mark to market with no gain, no loss. That's how you can understand it. So in this case, if you see, the mark price should be 300, and when you compare with market, so market price which is at 320. See, at this stage, of course, the borrower would be in loss, and borrower will have to refill the margin account, right? Because that contract was signed at, contract was signed at 300 and the current market price which is at 320. So it means in this case we'll have to sign contract, means yes, so broker will sign the contract for mark to market and compute the prices, and accordingly, if by any chance, let's say, or if anything unfortunate happened and market price goes below the contract price, in that case the broker will trigger the margin call to the concerned parties. Sometime it could be buyer, sometime it could be seller, so depends on the trade nature, right? In this case, if you see, the borrower would be the buyer, right? Because borrower had purchased securities from the original seller, so margin call goes to the buyer, and means borrower will have to pay additional 20 rupees. 20 means 24 per share, so 20 into 1000 quantity, if you just multiply it, 20,000 will have to pay to the borrower to the margin account. Okay, now what if at this point in time, if borrower decide to settle the account, if borrower decide to settle the accounts, then in that case borrower would be in a loss of almost 20,000. Why? Because the current market share price, which is at 20, and uh, the borrower had borrowed securities at 300, so it means borrower will have to purchase securities from the market at 320, so it means we'll have to pay higher price. Okay, so I hope you get it. But now on other hand, if I talk about, let's say, instead of this, so current market price, look at this, which is at this current market price, which is at 250. See, borrower had borrowed securities at 300 and sold in the market at 300 only, waited for, let's say, 1 month. Up to 1 month, the security price, which has come down at 250 rupees, and here see the in case of borrower, right? So what will happen? Initially it was sold, then now borrower will buy the securities, at 250. Sometime this buy trade, will call it as a cover as well in banking language. So now if we just try to compute the benefit, so sold at 300, buy at 250, just calculate the benefit, how much would be the benefit. So you can see the difference between sold and buy, which is 50 rupees. Okay, and the total quantities are 1000. So gross profit for a uh, gross profit for borrower would be how much? 50,000, right? Gross profit. And if you try to calculate net, so net would be somewhere, let's say the 10,000 was upfront fee, discussed. It was upfront fee. Sometime they charge upfront fee, or sometime they just charge commission, or depends how this the borrower or lender want to sign the contract. So depends on them. Then simply see on maturity what will happen. Contract was initiated, this, and settled at this level. So on settlement, what happened? Simply this 1000 securities, okay, 1000 securities, note down this one. Borrower will return 1000 quantities to the lender. This will happen on maturity, but one thing which is missing, that is a component part. Component, it means the borrower's commission. See, now commission, it could be let's say 10 rupees for per share, right? So this would be the again gross profit of lender. So the securities, this one and this one, goes to the In the books of borrower, you can see this. I mean, lender. Look at this. In the books of lender, what will happen, and in the books of borrower, what will happen. In the books of borrower, these things will happen. Right, on settlement date. And see, what happened on, means when the trade initiated. So you can, it looks like this. In the books of, let's say, lender, total holding 1000 quantity, and when they, let's say, transfer to the lend borrower, it looks like this. But this cell, it looks like as a placed. So it means available quantity would be 0 in the books of in the books of borrower. Look at this. Okay, and in the books of borrower, directly, the quantity looks like total means first would be buy trade for the borrower 1000 quantities, and then the borrower will directly sell 1000, okay, on trade initiation date. But when the trade will settle, available quantity like 0. Why 0? Purchase quantity 1000 and sell quantity also 1000. So it means there won't be any single means security even available in the books of borrower or when the trade executed or initiated, because the borrower wanted to sell it out in market, right? And that's what borrower sold it. But at the time of settlement, or when the trades got, let's say, settled or mature at XYZ date or XYZ time, so this is what the settlement level which we have discussed. So at this point in time, what happened then? Simply borrower, sorry. So borrower again buy the securities from the market and sell it back to whom? To the lender. And in the books of, let's say, lender, so initially it was sold. Now the securities 1000 quantities will be buybacked, and then it looks like available quantity again 1000. So here it should have 0 because it was placed. See, this is how things happened at settlement level, guys. So I hope now you understood this, how the borrowing or lending things works in the actual the banking system. And your job would be, when you join, let's say, bank like JP, Goldman, and if they hire you for settlement or SBL security borrowing lending, so your job would be like, core job would be reconciliations of stocks or quantities. So they'll have to means you will have to reconcile it to verify the total quantities or total value, total fees, commission, margin call, so that all will be part of security borrowing lending or collateral management part. Because in this process also, if you see, only we are moving collateral only. In a first trade, borrower is moving collateral to the the seller, and then seller is again transferring that collateral to the buyer, right? And once the security price goes down, the same seller is buying securities from the open market and returning that securities back, means collateral back, to the original owner. See, one thing which is very important in this process, during this period, if dividend, let's say, received, or interest payment received, or any sort of financial benefit received, all that benefit will goes to the original buyer. So it means lender only. And they sign even SBL agreement also. So I hope you get it, what I said. Okay. So during this process, if anything happened, then means in terms of financial benefit, or even if something happened, right? Even if something happened, what if, let's say, the company went on bankruptcy, or uh, let's say stock price skyrocket and goes to the, let's say, 5,000, 2,000, 3,000. See, it's not your headache. Ultimately, you have transfer 1,000 quantities to the borrower. So it means, as a lender, you will be getting 1,000 quantities from the borrower only. So borrower will be responsible for all of that arrangement. So it's not your headache, because on time to time the broker will collect margin in the margin account, and even ensure the timely settlement of securities as well. And if, let's say, if something happened and borrower denied to pay, then already borrower has collected the margin from the borrower. So trade will get closed automatically, and as a lender you will receive your benefit fees and whatever, you know the difference of price which you would see, that you will receive to you. So this is how basically SBL works. Now if I put it everything in Excel draw to just understand in the better purpose. So when the current price was 10, the, let's say, this contract was executed. This flow wouldn't be appropriate, because we'll have to lender, borrower, as we have discussed. So let's say quantity, if lender, Wipro quantity, 1,000 if transferred to the lender. This is actually case, if you look like, it's a buy and sell trade only, technically, buy and sell, because this one would be the seller, this one would be the buyer, and once the security quantity received, so same borrower will sell the quantities to the another buyer in the market. Okay. But so actually, if you see, originally the trade is between these two parties only. See, lender has nothing to do with borrower's further trade. How the borrower want to utilize the borrowed quantities, lender has nothing to do with that part. Lender is responsible only for you know the lend securities to the buyer. And this particular thing happened on uh, trade date. Trade date. And on settlement date, so on settlement date, what happened? Again, same same borrower maybe can buy the securities from the open market, or can ask broker to arrange the securities from the open market, so that on the predefined maturity or settlement date, so borrower will deliver securities back to the lender. Buy shares from broker or lender, sorry, broker, or maybe again can lend security from uh, another lender also, right? Because ultimately this first trade will have to close it. So to close that particular trade and deliver securities to lender, so this is how things looks like. But again, initially it was sell, so now this will buy, and this will sell. But one thing which is very important, guys, in SBL what happened, the buy and sell which happened at same price between these two, even if price change in market. So how they'll do it? One quantity is equal to 300, and even if price goes down in market, still they'll execute the transactions. One quantity is equal to 300. That's all. Now your question would be, sir, what then in this case? You can see like there is no profit, there is no gain. No, wait. So this person will receive the let's say it could be as I said 10 rupees the commission for per share, so it's additional income. And this party would be maybe in profit due to price difference, because price which was at 250 and now sorry, at the time of contract the price was at 300, but now price which is at 250, so it means there is there is a gain of 50 rupees. So this is what you can see, and on trade which is settled at 50. Okay, so look, so now in short, if you ask me, sir, what is SBL and why we do this? See, at a retail level, like our level, which is not possible, and even most of the people, they don't do this, right? So at a retail level, security borrowing and lending, which is not possible, but that doesn't mean you can't do this. You can do this. If you have any, let's say, borrower or lender, you can do this. Okay. Now, when I say possible, it means, see, all are like broker driven trades where stock exchange, which has nothing to do with all of these transactions. Broker take a risk, invite borrower, invite lender at one place and execute this SBL transaction. If something happened, let's say if the borrower goes default on payment, if anything happened, so it will be a responsibility of a broker to take care of that matter, and that's what broker will charge brokerage or commission or advising fees, so and so forth. Okay, so it's there is nothing. I mean, you can see with stock exchange or depository where they'll be responsible for this particular trade. No, because The SBL, which is broker driven activity, so because broker will take the responsibility and ensure that the execution of settlement or trades on time. So your broker will ensure it, right? But yeah, so if you simply ask me what happened, then this is all like the lender lends securities to the borrower. Borrower you know buys it, and this hold securities in the account, then at settlement again sell it in the open market and return that securities. If I simply, let's say, draw the flow, lender lend shares. So lend, it means buy. Lend, it means, sorry, sell to borrower. Okay. So we'll call it as a trade initiation. Then once the trade happened, right? So this is what we'll call it as a trade open. So this trade which has been open, or it's an open position. Now trade is open. Okay. But on settlement, open trade, what happened on settlement date? Borrower return shares plus fees, whatever fees was, let's say, discussed, 1 rupees, 2 rupees, 10 rupees, 100 rupees, depends on the share price. So borrower return this. Okay. And then after, trade will close. Trade close. So look at this, how things happened. Then maybe if you try to do the same thing, in the books of borrower, then borrower will first borrow it, then sell it, again, buy it, sell it. That's how you can see. Now see, if you just see the net activity, what happened in the books of borrower and seller on trade initiation. On trade initiation, sell to borrower and on settlement date purchase from borrower. Simple. So this thing happened in the books of lender basically. If I talk about borrower, borrower book, purchase from borrower and on settlement or maturity of the contract date sell to the lender along with fees. Simple. This is very simple activity. So if you try to make it complicated, then we cannot understand it. Look at this now. Take the screenshot. What happened in the SBL? So this is the actual summary. Means these things you can see which happened in books of borrower. SBL. Borrower book, lender book. See, I have already explained but again I'll explain it. Why lender lend the securities? See, to to keep securities, in the portfolio idle, which will not give you any opportunity to generate some, additional income. But if you try to, let's say, lend the securities for a 1 month, for 1 year, depends on, your investment needs or investment strategy, then you can generate the return on investments as well. What I have seen, like hedge funds or big investors, like HNI investors, if they're holding securities for a longer period, then they lend the securities to the borrower through brokers. Why? Because anyways they have decided to hold the securities in portfolio for a longer term. But meanwhile, if anyone asks for a, let's say, borrowing, so they borrow it. There is no harm to borrow, right? And they can generate some return on investment as well. And now, again, question remains same, like why borrower is doing this, all of this, mess. See, borrower is doing because borrower want to sell the securities without holding any security in the portfolio. So borrower just want to, sell the securities in market. But to sell the securities in market, first borrower will have to purchase the securities from the lender then, right? So without holding an security, you cannot sell it. But on a stock market screen, if sorry, on a broker side, if you just go, let me walk you through what happened.
This meeting is being recorded.
Oops. I'm not able to log in my account. I don't know. If the site is down, then we won't be able to do it. So let me try to log in this account today and see. Yeah, here we have. Again asking for same. This is ridiculous. I mean, on a weekend, sometime you can see this. I don't think so. You would be able to log in through this. Okay. Anyways, so now let's take example. This is your stock market account. Okay. So if you want to, let's say, Masgaw Doc, all right. So now I'm not holding any Masgaw Doc securities in my account, but still I want to sell this securities. Okay. So simply click on this, select the quantity, let's say one, and you can sell it out in market. But unfortunately, as I said, so the brokers, they don't allow directly to, me to sell. Only if you have, let's say, good connect with broker, then only broker will allow you to sell the securities in market. But I'll have to pay all this full amount, which is, let's say, 2923. I'll have to pay back to the uh, uh, grow to sell the security. So if you want to short sell, simply just click on sell instead of buy, because in normal way what happened, we just click on buy and try to buy the securities. But here what you can see, like, uh, will have to means you'll have to click on sell, select the quantity, pay the amount and sell it. And that trade actually, it would be in your okay, this is little different view, which say, oops. Okay. See, you can see trades here only, okay, under open positions, but I don't see any separate tab as open positions, but you can see here only. 40,000, I have to edit 70,000, 14, 80, 20, and here, so 13. All right. So, yeah, in general, I mean, you can't directly sell the securities because it will not allow by broker. But the big investors, as I said, they actually maintain a good rapport with broker and ask broker to do this. So broker will make sure that the securities are available, and that's how you can do it. But as a retail investor, if you want to sell this particular security, okay, and the broker is not allowing to do it, then what you can do, look for option trade. Let's say for this one, but there is no option trade available, so at the moment you don't have any other option. But still your question would be, sir, what if I want to do it? Then you will have to look for any CFDs as well. So contract for differences, like derivatives outside of the market. So you can find broker and and sign CFD with them, and then you can sell the quantities. But the brokers, they allow to do this, to the only the big investors or HNI investors, and they manage this entire show. See, let me tell you something. SBL is means security borrowing lending is a very big market, and you can see, like, millions of transactions that happened in SBL, because short selling is common thing in stock market. But in Indian market you can't see that options. The brokers, they are new in this segment, so they don't want to take a risk. But still I would like to check, is there any broker who can offer short selling of shares. If the option is available, means like put call, then you don't need to sell the securities, so you can directly sell the put or call different. My question was this, but what happened with this? uh, Interactive broker trade 0 eToro, but I'm asking for Indian market. But looks like these are not Indian brokers. So means through CFD only you can do it. Because short selling is huge risky, so most of the brokers, they don't allow it. The interactive broker, which is foreign broker, might be, but in foreign, see guys, short selling is common, but in Indian market you can see lots of other regulations. We have only plain vanilla tradings, like buy and sell. You can do it in future, that I know it, but I just want to directly sell. Sorry. Net short selling, which is not allowed it. So what do you mean by neck selling? Neck selling, it means without paying any margin or something, you have just taken position. So in that case would be very risky. So which is not allowed in Indian market. But as far as I know, most of the brokers, they don't have a framework for this. This is the annexure board details. Just go through this. What is allow, what is disallow, you can see in the details. and this will give you much insight about it. Just go through this, because this is what something it's all about. uh, it's all about, whether it is Allah or not. But I still remember, for intraday, I think the short selling was allowed with one of the broker. I had tried with couple of securities. With Tata Motors, I had placed a couple of trades for short selling way back in 2019, I believe. But then after, I didn't try this because it's huge risky. But that day, fortunately, I was in a profit of 51,000. But luck cannot be work, every time. So just go through this blog, guys. So for short selling, and whatever that we have discussed here, this is all about the SBL, security borrowing and lending. So in Indian market, it seems like